There are 20 categories of equity mutual funds, but there's one category which has beaten down most fund categories. This category is the category of dividend yield funds. Look at the table on your screen. Dividend yield funds have delivered amazing returns of 21.97% in the past 3 years. This category of funds has beaten down some of the biggest equity mutual fund categories, including flexi cap funds, over a 3-year period. But what are dividend yield funds? Do they pay dividends? And many more questions is what we'll be answering in this crisp video. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. Let's start with the basics. As per definition, dividend yield funds must invest at least 65% of their corpus in high dividend paying companies. Currently, there are 10 funds in this category, and together they manage 31,500 crores of assets. The biggest fund is SBI Dividend Yield Fund, which is a 9,500 crore fund. But before we move on to further details, let's understand what are dividends. So for starters, investors earn in two ways from stock investment. First, through capital appreciation, that is an increase in stock price, and second is through dividends. Now, dividend is basically part of profits that the company decides to share with its investors. Some companies pay regular high dividends. But how do you know if a stock is a high dividend paying one? Well, for that you can look at the dividend yield ratio of the stock. Dividend yield ratio is calculated by dividing the dividend paid by the company with the stock price and multiplying it by 100. For example, Vedanta Limited paid a dividend of 29.5 per share in March 2024. At current share price of 440, the dividend yield will be 29.5 divided by 440 into 100. That comes out to be 6.71%. Now, to understand if a stock is high dividend paying or not, you need to compare the dividend yield ratio with others in the industry. Or another simpler way is, you simply invest in mutual funds that invest in high dividend paying stocks. But you may argue that even other funds can invest in high dividend paying stocks. Yes, they can. But these funds have to mandatorily invest at least 65% of their portfolio in high dividend paying companies, as mentioned earlier. Now let's address another big confusion that investors have about these funds. Do they pay high dividends to investors as they invest in high dividend paying stocks? Let's find out. Here you need to understand that dividend from stocks is different from dividend from mutual funds. So whenever a mutual fund receives dividends from stocks, it is not directly transferred to the investor's bank account. As the money is received, it is held as cash or in highly liquid, low-risk debt instruments, sometimes called cash equivalents. Because of this extra cash, the AUM goes up, and you'll also see an impact on NAV. It will also go up due to these dividends coming in. But this is temporary parking of the dividends. Then, as the fund manager finds the right opportunity, he invests these dividend payouts so that this money grows as well. This process of how dividends get used is followed even if you have a dividend plan of a fund. This can be quite confusing. However, the dividend plan's payout to its investors is not a dividend received from a company, but a part of returns generated by the fund, which is given to investors. Therefore, whenever the management of fund or trustee decides there is investable surplus, they may pay a dividend, but these are not guaranteed, even in case of dividend options of mutual funds. So this is how dividend from stocks is utilized in mutual funds. Therefore, dividend yield funds may not pay high and regular dividends, but you should know that they benefit from investing in high dividend paying companies. Hope this is clear to you now. If you have any queries, please let us know in the comment section and we'll answer it for you. Dividend yield mutual funds are basically a way to invest in high dividend paying stocks. But how do they define high dividend yielding stocks? Well, different funds define it differently. For example, SBI Dividend Yield Fund picks up dividend yielding stocks which have dividend yield of more than 50% of Nifty 50 index, and the company should have paid dividend in 1 out of 3 years at least. Tata Dividend Yield Fund simply says it should be higher than Nifty 50 index. But apart from this, they do not have any restrictions for picking stocks from different sectors or market caps. Probably that's why Nifty 500 TRI is the benchmark for most funds. Therefore, they can invest across sectors and capitalization. Basically, you can say they are flexi cap funds that invest in high dividend paying companies across market cap. But there are differences in returns of these funds. So this was the basics about dividend yield funds. Of course, these funds have done well, but to know whether they are superior to flexi cap funds and if you should invest in them or stick with flexi cap funds, you may watch our detailed video on the same. The link is in the description. And it's a wrap. If you like the video, do subscribe to our channel and share the video with your friends and family as well. And we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.